Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management. Today is July 25th, 2022, and we're going to go over the three threes for the week. We're going to go over the three top market movers, and it's going to be an exciting week this week. Our three favorite and least favorite asset classes, and how we're positioned on the equities and on the bond side, and have we bottomed? Let's jump on in.
Okay, let's go over the top three market movers for the week. Number one, earnings, and more earnings. Number two, the FOMC meeting will conclude on Wednesday, and GDP will be reported on Thursday. Let's go over number one, earnings. A lot of the big tech companies will be reporting this week. We have Alphabet and Meta. They'll tell us a little bit more about the ad spending that's going on. Amazon and Microsoft will give us a good look at corporate spending. And Apple will tell us more about the consumer. We also have Walmart and Target this week. So lots of big companies coming out and reporting this week. So it could be exciting. Number two, interest rates. The Fed is widely anticipated to raise rates by 75 basis points Wednesday. There's a 75% chance that they're going to do that. After the hot CPI report last week, there was a full point discussion, and right now it's sitting at 25, but my money is on they're going to continue to go 75 basis points at this meeting. All right, let's talk about GDP. The first version of the second quarter will be reported on Thursday, and the Atlanta Fed GDP now has it sitting at negative 1.6. Now, that just so happens to be the first quarter's US GDP was negative 1.6. So two negative numbers, rule of thumb says that we are in a recession. Okay, so we'll see what happens, but the rule of thumb, the textbook definition says, yes, we're in a recession. But Secretary Yellen came out on Sunday and basically said the labor market is now extremely strong. This is not an economy that's in recession, but we're in a period of transition in which growth is slowing. So we're not in a recession, Yellen. Well, Yellen, you also forgot, you were wrong about inflation just a few months ago, but we'll go ahead and believe you this time because you are right on this one. And just in case she's not right, the White House basically just changed the definition for two negative quarters in a row. So it's not a recession if you basically change the definition of the recession is what the White House is doing. So I don't know. I'm going to call it we're in a recession. It may be extremely mild, but we are definitely in a recession. All right, let's go over the top three asset classes for the week. The no change, we still have US dollar, T-bills, and commodities, so it's still safety. Even though we're nibbling in certain areas, the big major asset classes are still says be careful. And the bottom three asset classes is global equities, NASDAQ, and gold just enter there. They've been going in and out of the bottom three asset classes for a while now. Okay, let's go over, have we finally reached a market bottom?
Okay. Have we finally reached a bottom on the equities and on the bonds? Well, here are the equities. I know I've gone over this multiple times with you, this graph, but let's focus in over here. Last week, we started nibbling and buying in the equities, okay? We avoided this huge drawdown, and now we're buying them, just like we avoided this one and started nibbling. Oh, false alarm. I don't know where we're going to go, but right now we're starting to nibble on the equity side. All right, so does that mean it's a bottom? Well, let's go over the last 50 years where we've had a recession and we've had a bear market. Look at these declines, the smallest one being 27, the largest one being 50, almost 57%. Look at the number of days, the shortest being 400 and the longest being 900. That's 3 years in a major drawdown back in 2000 through 2003. But I want to focus your attention on this column right here. This is the times that we went from protect to add. This year we've gone twice, right? Over the last 50 years during these periods, we've gone 4, 5, 7 times. So I'm not sure if this is the bottom, but it's definitely a bottom for short term. And we'll have to wait and see if this is the bottom in equities. We'll have to wait another week, month, or even longer to find that out. But what about bonds? Okay. Well, if you remember 2 weeks ago, we were nibbling and buying bonds 2 weeks ago. And guess what? The price are moving up. Okay. So far so good on the bonds. Okay. And the good news is we avoided this major drawdown because we went to protect mode really at the beginning of this year, and now we're starting to nibble and buy bonds. Okay, so we avoided this huge drawdown of 13% on bonds on a buy and hold. We sold, and now we're starting to buy bonds. So let's take a look at how that looks on the graph. And yes, I know bonds have been in a 40-year bull market, with it peaking in 1981 at 16%. So yes, I understand all that, but let's take a look at the periods where we've had some drawdowns on bonds. 2008, there was almost a 15% drawdown. Number of days, 49, it basically bounced and did a V-shaped recovery. We had a small little drawdown in 2013, 16, 17, 4%, but let's focus on 2022. Again, yes, recession, yes, bear market, a 14% drawdown on bonds, very similar to 2008. But look at the number of days. We were so low on interest rates over the past year, they have just been going up, which broke this bull market, okay? So you can look over here, we've gone through protect and add twice on bonds and twice on equities. Again, I'm not sure how many more times we're going to go, or is this the bottom or not, but I can just tell you it is a bottom, and so far so good on buying selective equities and bonds. Okay, but Jim, they're raising interest rates here on Wednesday, and you're buying bonds? Yes, and I'm going to go over why and what a difference a week makes. Here are the Fed projections. Okay, this is the FOMC meetings, and they basically said in the February 2023 meeting, they're going to pause. They are not going to raise interest rates anymore and pause based on 7/18. Well, a week later, CPI report last week had a lot to do with it, but they came in and moved the meeting up to December, saying we're going to pause in December. So that is why yields started to come down and prices for bonds started to go up. Yay us, okay? So what a difference a week makes, and we'll see what the next week makes because we have our Wednesday meeting and the Thursday meeting where they're going to go over GDP. So anticipate some more movement on this chart. All right, so again, why is this important? Because you have to have an investment process, a very systematic process that gets you out and gets you back in when it's time, instead of buying and holding and hoping that bonds and equities are eventually going to save you down the road. And this buy and hold and buy the dip mentality, we're not in that environment anymore. So you've got to have an investment process that is going to protect you and get you back into this market when you need to. That's it. Thank you for joining us. Our next update is Monday, August 1st. So please subscribe and like and watch some of our other videos. And if you have questions or comments, please go ahead and add those. And we hope you have a wonderful week. Thank you for joining us.